Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Every now and then on Fear and Greed, we get a bit of a 101 on different types of investing. Today, we're looking at CFDs, or a contract for difference, which is a form of derivative trading where you speculate about the rise or fall of different markets, commodities, currencies, and the like. I've gone to an expert for help with this one. Adam Smith is the CEO of Saxo Markets Australia, a global multi-asset trading and investment platform, part of Saxo Bank. Adam, welcome to Fear and Greed.
Hi, Sean. Great to be with you.
Now, you're going to have to dumb it down for me on this one, Adam. CFDs have always been slightly confusing to me. So let's start with some of the terminology. You know, when we talk about what a CFD is, leverage, derivatives, that type of thing.
Yeah, no problem. I'll start with what a derivative is because it covers the sort of class of products that we may well talk about over the course of the next few minutes. But basically, a derivative is a financial product that gains its value from the value of another asset. So what that means is a derivative can be a product that looks to share prices, stock indexes, commodities like gold, or foreign currencies like the Aussie dollar for their value. So being a derivative product, it can include options, it can include futures, it can include CFDs or contracts for difference, as you mentioned.
Okay, so a derivative, it could be as simple as buying a share in McDonald's in the US and taking a hedge or a derivative against moves in the Australian US dollar exchange rate.
Yeah, very definitely. And that's a very good use case for CFD. So, I'll even take it a step further. So at the moment, if you wanted, as a, retail investor in Australia, wanted to buy an Amazon share, You're currently looking at around $4,500 to buy one share. Now, that potentially is beyond the reach of a lot of people. They don't want to invest that much, or they don't have, that much to invest. So you can buy a CFD over Amazon for a fraction of the price. And so in Australia at the moment, you need to stump up basically 20% of the cost of that share. So that gives you an exposure to Amazon. You might like the company. I mean, Lord knows nearly everyone's been using it over the last 15 months. So we understand the business model. And you might want to own a part of that company.
So I'm going to jump in there, Adam. So what we're saying, derivatives is the generic term. Underneath that, we have CFDs as one such product. And this is what you're talking about in terms of Amazon, how you get into Amazon.
Correct, that's right. So as I said, options, futures, CFDs, they all sit within the derivative asset class, but they all have different characteristics. And so with a CFD, the payoff, so the return, the investment return, looks a lot like if you bought a stock. So goes up $1, you make $1. It goes down $1, you lose $1. But with something like an investment in Amazon, you don't have to pay the full price of the Amazon share to get that exposure.
Yeah. So if I'm buying 20%, do I get 20% of a share, or am I actually buying the full share but not paying up front?
Yeah. So you are actually buying exposure to a full share. You don't actually own the share. That's important to recognize as well. But the CFD provider will effectively lend you the 80% balance that is required for you to have an exposure to one full share. And that's an interesting point as well, because that is effectively the leverage that we talk about when we talk about derivative products. So the leverage is the lending component, which in this case would be 80% of the value of the share. So you pay 20%, CFD provider offers you 80%, and then you've got an exposure to one Amazon share.
Okay, so if I'm confident Amazon is going to go from $4,000 to $8,000, and I need to be confident about that, and I buy a CFD for Amazon, which gives me 20% exposure, I get the benefit of the upside, presumably, and of course it works the reverse as well.
Correct, that's right. So you'll, effectively the example you've used there is there's a doubling in the Amazon share price. So that's fantastic. You've contributed, 20% of the value of the Amazon share. So you've made a pretty reasonable return there. But as you say, the downside also needs to be taken into consideration in the sense that if the Amazon share price falls, you risk the capital that you've put in the same way that you would if you had bought the ordinary share. So you're exposed to the upside and the downside, but because of the leverage in the product, gains and losses can be magnified. So, a doubling of the share price, you make $4,000 in this case, off an investment of 20%, which is $800, is a 5 times return. That's pretty good.
Yep.
But obviously, the same applies to the downside. You can lose your investment, in this case, which would be $800, and that obviously means that the capital is gone. But again, that's the same sort of risk that you take when you buy a share. It just so happens that you've taken on a bigger position.
So in the Amazon, just to round it out, if the share price from Amazon goes from 4,000 to 3,000, does the provider ask me for more money, or how does that work?
Yeah, so no, they don't. So you will be, or you may be familiar with some of the changes to the CFD product that have been introduced by ASIC, and that happened back in March of this year. And it's a really important thing to consider because CFDs are a risky product. They're a leverage product. So as I said, returns can be magnified both to the upside and the downside. The protections that ASIC have introduced include, some really important protections for clients, and one of which is negative balance protection. So now if you're a retail client and you trade a CFD, you cannot lose more than you invest. Right. And that's a really good thing. That's a really good thing.
And that's a big difference to 10 years ago when the global financial crisis, CFDs didn't come out of that looking real good. But part of the issue was the fact that you could lose more than the capital you put in, but you can no longer do that.
That's correct. And you're absolutely right. CFDs have a bit of a checkered past, and I sort of think of them as the ugly duckling in the financial sort of markets product set. But it's probably a little unfair because the product itself is not the issue. It's the use of it and the leverage that's been able, to be offered to clients. So the other thing that ASIC did, in addition to introducing negative balance protections, was that they reduced the amount of leverage that you can actually take on positions like this. So before March this year, you could take a position with 500 to 1 leverage. So for every dollar you invested, you got $500 worth of exposure. Now that's, to my mind, and certainly Saxo's position is quite conservative on this, that's an irresponsible sort of product that was being offered to clients. Because if you think about it in a pure mathematical sense, that means your investment only needs to go south if you bought something by 0.2 of 1% before your capital is wiped out. That's a pretty small margin for error.
Yeah.
And so if you've been investing or trading for a while, you would appreciate that markets don't go straight up and they don't go straight down. They sort of, they move around over the course of a day. So your potential for being closed out on a position like that is very, very high. High probability of closeout, so high probability of loss making. So what ASIC's done, again, which we're fully supportive of, they've reduced the amount of leverage available in these products. And that also is important for the users of the product because a lot of people spend a lot of time and effort, analysing investment markets, trying to work out where a good return may come from. And so you need the product to be able to support you. So previously, frankly, you were rolling the dice, but now it's a much better outcome for people who like to do their homework and like to invest in leverage products because they can generate fantastic returns. They are great diversifiers for portfolios, and they're also a great risk management tool. So they've got many uses.
So just before we get into that, so it was 1 to 500. What's the rule now from ASIC?
Yeah, look, it's pretty much so on a single stock, it's 1 to 5.
Right. So it's got to go down 20% before you lose your...
Correct. Exactly right. So that's my example before around Amazon. The 20% margin is actually where we are at the moment for single stock CFDs.
Okay.
Currencies are a little higher in terms of the leverage element, but it's only around 30 or 33 to 1 from memory. So, but that's because currencies are less volatile. And I think that's also important to recognize is that the Aussie dollar US dollar pair is a lot less volatile than the ASX 200, over time.
Yeah.
And so the way people think about this is you want better protections around the riskier assets, which is why things like crypto are actually 2 to 1. So it's 50% leverage as opposed to currencies which might be, 33 to 1. Indexes, so ASX 200, NASDAQ, S&P 500, from memory around sort of 5 to 1, and then stocks at 10 to 1. Or, the other way around,
Stay with me, Adam. We'll be back in a minute. My guest this morning is Adam Smith, CEO of Saxo Markets Australia. So are these mostly in the orbit of professional investors, or are there many sophisticated high net wealth investors doing it? And are there many retail investors involving themselves in CFDs?
Yeah, lots of both, to be fair. So these protections that ASIC have introduced are for retail investors, and that's a classification that ASIC use. There is also a different class of investor called wholesale, but we can touch on those in a minute if you want to. But yes, the answer to your question is that a very broad spectrum of clients use these products. And as I said, for quite different reasons. So a lot of clients at Saxo have equity portfolios that they want to keep, long term, might be an ASX portfolio, might be a US portfolio. They don't want to turn them over all the time. It might be just they've got a long-term view or they don't want to generate tax events, all that sort of stuff. So they'll use CFDs to hedge, as you mentioned before, against currency movements. If you've got a US dollar asset, so you own Amazon or Apple or Netflix or whatever, you're exposed to the movements in the Aussie dollar. So you might take out a currency CFD to hedge your position there. Similarly, there are other opportunities in CFD world, and I think that's the beauty of the product, is that it democratizes investment. So retail clients who typically may not have the capital base that wholesale or professional investors do can access these markets and can access investment ideas and opportunities, again, that they may have come about, through their own analysis or they may have read about. So I look at things like gold. Gold's a great example. Like, not many people can afford to go out and buy a gold bar, but you can buy a gold CFD for a fraction of the price. And, it can be a better alternative than an investment in a gold stock, because you don't know which company is the best company. You may not have the time nor the inclination to work that out. You just want a pure exposure to gold. And so you can go and buy a gold CFD. And that means that you can fractionalize your investment. So you can buy as much as you want. And at the end of the day, I think the thing to remember with these types of products is you need to do your homework, you need to manage your risk, you need to be able to sleep at night. So if your investment threshold is $1,000, these products allow you to go and buy $1,000 worth of gold. If it's $10,000, fantastic. If it's $100,000, even better.
Okay. And the other thing I often think about investing with CFDs, you need to be an active investor too. So they're not set and forget products.
Well, I disagree a little bit there, because I think they can be.
I know.
And because, again, it's about the amount of risk or exposure or leverage that you want to take. So we have a lot of clients that will take a small position in a stock, and again, they'll look to see how the stock performs over time, and it forms a part of their portfolio. They may then add some more. It can be Aussie stocks, it can be CBA, BHP, it can be anything overseas as well on the US markets and internationally. So it's not necessarily just the domain of the day trader. We have a lot of clients who have built portfolios around CFD products and single stock and index CFDs as well. So product lends itself to each style of investing, whether it's short-term trading, long-term investment time horizons.
I've learned a lot this morning. Thank you, Adam. Thanks for talking to Fear and Greed.
Been a pleasure. Thank you.
That was Adam Smith, Chief Executive Officer of Saxo Markets Australia. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.